If you've ever had a hard time figuring out where the hell to take profit, trust me, you're not the only one. Most traders catch great setups, but then price flips right before hitting their target. Super annoying, right? That's where standard deviation comes in. In this video, I'll show you exactly how I use it. It's an advanced ICT idea to find high probability profit zones and add some solid confluence to my trades. We'll talk about what it is, how to set it up on your chart with Fibonacci, and most importantly, how to actually use it in live trades, so you can stop guessing and start trading with confidence. Let's dive in. Alright, before we jump into the charts, let's just make sure we're all on the same page about what standard deviation actually is, and why it's so damn useful. Don't worry, it's not some crazy math formula. In trading, it's basically a fib-based tool that helps you figure out how far price might move from an important point. So first, grab your Fibonacci tool and tweak the settings. The levels I use for standard deviation are 1, 0, 1, -2, -2.5, and -4. You can mess around with it later, but these ones give me the cleanest, most accurate targets. Now, this doesn't tell you when to enter a trade. It tells you where price is most likely to go once the move starts. Think of it like a road map. When price makes a manipulation leg or a big move off a key level, standard deviation helps you map out realistic targets instead of just guessing or trading on emotion. Here's the key part. You only want to use standard deviation after you've spotted a clear change in delivery, meaning when the market shifts direction. For example, say we're in a downtrend and price suddenly flips bullish. You'll see it sweep liquidity first. That move right there is the manipulation leg. To find it, you'll spot the low after that structure shift. Then mark the high that caused that low. Alright, so that whole swing, from the high down to the low, that's your manipulation leg. Now that you've spotted it, we can go ahead and draw our fib. If it's a bullish setup, anchor your fib from the low to the high that created that low. If it's bearish, just flip it from the high to the low that created that high. Once you do that, your projection levels pop up, and those are your standard deviation targets. Now, when the manipulation leg is a normal size, price usually reaches around the -2 or -2.5 level. That's a really common area to take profit. But if the market's expanding and volatility kicks in, you might see it push all the way to -4 or even -4.5. In those zones, you'll often notice liquidity pools, things like equal highs, equal lows, or imbalance areas like FEG. That's where I look for confluence. So if my standard deviation target lines up with liquidity, that's usually my take profit zone. Now, if the manipulation leg is huge, like it covers a massive range, I don't expect price to reach -2 or -2.5. In that case, I usually aim for around the -1 level instead. It's safer, more realistic, and still gives you solid profits. And just remember, standard deviation isn't a signal. It's not telling you to buy or sell. It's just a tool for confluence, helping you add precision to your trades. You still need your ICT framework, things like market structure shift, liquidity sweep, order blocks, and fair value gaps, to build your setup. Then, once you've got your trade idea ready, use standard deviation to map out where you expect price to reach. That's how you avoid guessing and start trading with precision and confidence. Right, let's go over this example together. It's actually one of my recent trades. Here we've got the daily chart of Pound USD. As you can see, price has equal highs and equal lows on both sides. So I was expecting the market to first grab the liquidity above those equal highs, and then move down toward the equal lows. That's why I was waiting for a manipulation leg to form here. Well, things played out just like I expected, and now we've got a shift in delivery. We're supposed to find the lowest point, then identify the highest point that created that low, and that's our manipulation leg. Next, we grab the Fibonacci retracement tool, anchor it from the lowest point, drag it up to the highest point that formed that low, and using the settings we talked about before, we set our targets for this move. As you can see, our target levels line up perfectly with those equal lows, which makes this target valid, and sure enough, price dropped right into our marked zone. Alright, let's move on to the next example. Here we've got the 1-hour chart of the Dow Jones. So, after that sharp drop, price started consolidating and ranging, and that's exactly what created liquidity above the equal highs. Since we always want to trade in the direction of the trend, I was expecting price to push up into the FVG sitting above those equal highs, grab the liquidity, and then move back down. And just like we expected, price made a manipulation leg, showing a shift in delivery, and started moving lower. So we mark the low to the high of that manipulation leg, and look for targets that align with it. As you can see, our -2 and -2.5 standard deviations line up perfectly with those equal lows below, which makes it a solid target area where we can confidently set our take profit. So, to recap, use standard deviation to project realistic profit targets. Never use it as an entry trigger. Always pair it with your existing ICT concepts for confirmation. And the more you practice it, the more naturally it'll fit into your trading flow. If this helped you, drop a comment below and let me know if you want me to cover other ICT tools like projections, premium and discount arrays, or market maker models next. Alright, that's it for today. Let's keep learning, keep testing, and as always, trade smart.